Hey, this is Drew Page. Welcome to the Drew Page channel. In this video, we are going to go through the Robinhood lawsuit. We're getting toward the end of 2021 and we're going to end it the way that we began. My first viral video that got over 100,000 views was about the first Robinhood lawsuit. And we're going to end 2021 by talking about the lawsuit that was filed against Robinhood since the stock has tanked. This lawsuit was just filed on December 17th of 2021, and the law firm of Scott & Scott Attorneys at Law out of San Diego, California, filed this suit and have suggested a class action and filed a motion to make this a class action lawsuit so people who are similarly situated, much like the first Robinhood lawsuit, would be able to join the class. So we're going to walk through the complaint and see what the claims are against Robinhood. So first of all, the title of the lawsuit is Philip Golubowski versus Robinhood Markets, and it's of course listed Vlad Tenev and several other executives as well as board members who were either officers of Robinhood during the time of the public offering, or were board members who had to sign off on the offering documents, as we'll see. So it starts off with a summary paragraph, and then it goes through the nature and summary of the action. In paragraph 1, it says that the plaintiffs are bringing this federal class action under sections 11, 12, and 15 of the Securities Act of 1933 against Robinhood, certain company senior executives and directors, and the underwriters of the offering as well. So these sections under 11, 12, and 15 of the Securities Act are actually, in a large regard, the same statutes that I talked about in the Grant Cardone lawsuit in the video I did just a couple days ago. So if you haven't seen that, check that out as well. So he's named Robinhood, Robinhood's executives and directors, as well as the underwriters. The plaintiff alleges that the registration statement and the prospectus, which was filed with the SEC in July 1 and July 30 of 2021, including all of its amendments, contain materially incorrect or misleading statements and or omitted material information. So they're saying that the documents themselves were deficient. Unlike the Grant Cardone video where I mentioned that they were saying that the documents were misleading in light of statements that were made by Grant on social media. In this case, they're saying that the documents themselves had misleading information from the outset. Paragraph 2 states that Robinhood Markets, Inc. Is headquartered in Menlo Park, California, and is known for pioneering commission-free trades of stocks, exchange-traded funds, or ETFs, and cryptocurrencies via a mobile app. On or about, paragraph 3, on or about July 30, 2021, Robinhood conducted its IPO, its initial public offering, offering 55 million shares of its common stock. In paragraph 3, it states, on or about July 30, 2021, Robinhood conducted its IPO, or initial public offering, offering 55 million shares of its common stock to the public at a price of $38 per share, which was the offering price, quote unquote, for anticipated proceeds of over $2 billion. Paragraph 4, it is alleged that according to the offering documents, Robinhood is a, quote, safety-first company with a, quote, radical customer focus. It claims to be committed to, 1, quality execution, supposedly performing regular and rigorous reviews of the execution quality customers receive. 2, maintaining high security standards to keep customers' accounts safe. And 3, providing, quote, dedicated support to customers to resolve their issues swiftly. According to the offering documents, these commitments, its fresh, people-centric approach, and delightful, engaging customer experience has led Robinhood to build deep, loyal customer relationships and has positioned the company well to continue attracting new people to the platform and accelerate growth. So anyone who believes those statements anyway must not have watched my first video, because there were all kinds of customer complaints and problems back with the GME, GameStop, and the AMC movie theater debacles when the payment for order flow came and revealed that there was a problem, and people were prevented from being able to buy more, even though they were so kind to let us sell it while everything was going on the way up, but weren't able to buy it. And the outcry was huge, and the reaction for people using the platform was not all that customer centric, as you'll recall. But if you're not sure about that, go back and watch the video. I will note that case was dismissed, the one that was filed against Robinhood for the payment for order flow issue. That was dismissed not too long ago. I mean, the fact that the case was dismissed doesn't mean that it was all of a sudden a customer-friendly place, but I digress. Paragraph 5 says, unbeknownst to investors, these representations were materially inaccurate, misleading, and or incomplete because they failed to disclose that at the time of the IPO, Robinhood's revenue growth was experiencing a major reversal, with transaction-based revenues from cryptocurrency trading serving only as a short-term transitory injection, masking what was actually stagnating growth. Now, this is interesting because the Grant Cardone video, the problem was that Louis Pino didn't state sufficient facts to explain how the statements in the offering documents were misleading in and of themselves based on the information that was provided, and that it was protected by forward-looking statements of Grant Cardone. But here, they're saying that this is not an issue of forward-looking statements, that they knew at the time of the IPO that the revenue was experiencing some problems and that it was going into a reversal, and that cryptocurrency trading was a temporary measure and that it didn't have yet its long-term benefits to the company. And it essentially, according to the plaintiffs, masks the true revenue of the company, and that only people who had that information in the company would know that the general public was not made privy to that information at the time of the offering. It says, in addition, the company's significant investments in enhancing the reliability and scalability of its platform were patently inadequate and or defective, exposing Robinhood to worsening service level disruptions and security breaches, particularly as the company scaled its services to a larger user base. Paragraph 6. As these true facts emerged after the offering, the company's shares fell sharply. By the commencement of this action, Robinhood shares traded as low as $17.08 per share, representing a decline of over 55% from the offering price. I note that in the conversation with Graham, Stephan, and Brandon Turner on the Iced Coffee Hour, he was trying to convince his employee Jack to sell his Robinhood shares because he said that when Jack got in, everything went down. So maybe they need to include him. I'm just kidding. They don't need to do that. But, I mean, Graham has a apparently significant position in Robinhood. Maybe he needs to jump in on this lawsuit. We'll see. Paragraph 7. By this action, plaintiff, on behalf of himself and other members of the class who also acquired Robinhood shares, seeks to obtain a recovery for the damages suffered. Paragraph 8. The claims asserted herein are purely strict liability and negligence claims. Plaintiff expressly eschews any allegation sounding in fraud. Now, I talked about this a lot in the Grant Cardone video, but the bottom line is that Rule 9 requires in federal courts that if you're making a claim of fraud or if your claim sounds in fraud, it is subject to a higher pleading requirement. So you have to put more detail, more specificity in the complaint. And the plaintiff is not protected by saying, well, this case isn't fraud. It's based on what the information is. It may sound in fraud, but they are claiming in this element that they are not seeking a claim of fraud, nor are they trying to sound in fraud. Paragraphs 9 through 13 deal with the issues of venue and jurisdiction. Basically, it's appropriate in the proper court because of the location of where the defendant's headquarters is, as well as where the communications regarding the IPO took place. So I'm not going to go into all of those. Paragraphs 14 and 15 through several others include the information about the parties to the suit. Paragraphs 16 through 24 list the individual defendants like Vlad, Jason Warnick, Baiji Bott, Jan Hammer, Paula Loop, Jonathan Rubenstein, Scott Sandel, Robert Zolik, and these are the ones who are either corporate officers or members of the board who signed off on the offering documents. Then, interestingly, they have a list of underwriter defendants. And the underwriter defendants are included in this big list. This is really cool that they included this chart in the complaint. And it lists each of their names, which includes Goldman Sachs, JP Morgan, Barclays, Citigroup, Wells Fargo, Mizuho, JMP, KeyBank, Piper Sandler, Rosenblatt Securities, BMO Capital Markets Corp., BTIG, Santander Investments, Academy Securities, Loop Capital Markets, Samuel A. Ramirez and Company, and Siebert Williams Shank & Co. And it also lists the number of shares that were put out at the public offering from each of these companies on behalf of Robinhood. So I'm not going to read all of the paragraphs relating to these because obviously that would be extraordinarily redundant. So I'm just going to start with the one regarding Goldman Sachs because they are the largest. It says defendant Goldman Sachs was an underwriter of the company's IPO, serving as a financial advisor for and insisting in the preparation and dissemination of the company's material, inaccurate, misleading, and incomplete offering documents. Goldman Sachs acted as a representative of all the underwriters. Goldman Sachs also participated in conducting and promoting the roadshow for the IPO and paying for the expenses of the individual defendants who participated in the roadshow, including lodging and travel, among other expenses. Goldman Sachs' participation in and its solicitation of offers in connection with the IPO was motivated by financial interests. Defendant Goldman Sachs conducts business in this district. And basically, word for word, other than changing out the names of the defendants, the information is all the same all the way through paragraph 42. Paragraph 43, it says that they are collectively known as the Underwriter Defendants. In paragraph 44, it says, pursuant to the Securities Act, each underwriter defendant is liable for the materially inaccurate, misleading, and incomplete statements of the offering documents. And then it also states that, in addition, although not an element of plaintiff's claims and an issue on which each underwriter defendant bears the burden of proof to the extent it seeks to assert it as an affirmative defense, no underwriter defendant conducted an adequate due diligence investigation in connection with the matters alleged herein and will accordingly be unable to establish a statutory due diligence affirmative defense under the Securities Act. Each underwriter defendant committed acts and omissions that were a substantial factor leading to the harm complained of herein. They could argue as a defense that they did due diligence and that they were just essentially deceived as much as the public to be protected from this lawsuit, but the plaintiff is alleging that they did not perform due diligence and therefore would not have those protections. In paragraph 45, each underwriter defendant named herein is an investment banking firm whose activities include, among other things, the underwriting of public offerings of securities. As the underwriters of the IPO, the underwriter defendants earned lucrative underwriting fees. As underwriters, the underwriter defendants met with potential investors in the IPO and presented highly favorable but materially incorrect and or materially misleading information about the company and omitted to disclose material information required to be disclosed. Paragraph 47, representatives of the underwriter defendants also assisted Robinhood and the individual defendants in planning the IPO. Paragraph 48, in addition to having access to internal corporate documents, the underwriter defendants and or their agents, including their counsel, had access to Robinhood's management, directors, and lawyers to determine 1, the strategy to best accomplish the IPO, 2, the terms of the IPO, including the price at which Robinhood's common stock will be sold, 3, the language to be used in the offering documents. 4, what disclosures about Robinhood would be made in the offering materials. And 5, what responses would be made to the SEC in connection with its review of the offering materials. As a result of those constant contacts and communications between the Underwriter Defendants representatives and Robinhood's management directors and lawyers, at a minimum, the Underwriter Defendants should have known of Robinhood's undisclosed then existing problems and plans, and the offering documents materially inaccurate, misleading, and incomplete statements and omissions as detailed herein. So I don't know if they're going to win this, but these lawyers did a great job drafting this complaint. It's very detailed. It's got specific allegations. It's not just the elements of the offense. It's not just conclusory statements. They're saying these are the ways that these people could have produced some due diligence. So again, I don't know whether this claim survives, but it's a very well-written complaint so far. Of 49, the Underwriter Defendants demanded and obtained an agreement from Robinhood under which Robinhood agreed to indemnify and hold the underwriters harmless. Paragraph 50, the Underwriter Defendants caused a registration statement to be filed with the SEC and declared effective in connection with the IPO so that they and the individual defendants could offer to sell and sell Robinhood shares to plaintiff and other members. So that's the background, the naming of the parties, how they're responsible according to the plaintiff. Now we get into the actual allegations. Paragraph 51. On July 1, 2021, Robinhood filed with the SEC a draft registration statement on Form S-1. On July 25, 2021, Robinhood filed its final amendment to the registration statement, which registered 60.5 million Robinhood shares for public sale, including 5.5 million shares that the Underwriter Defendants had the option to purchase, solely to cover over allotments. The SEC declared the registration statement effective on July 28, 2021. On July 30, 2021, defendants priced the IPO at $38 per share and filed the final prospectus for the IPO, which forms part of the registration statement. Paragraph 52. The offering documents were negligently prepared and as a result contained untrue statements of material facts or omitted to state other facts necessary to make the statements made not misleading, and was not prepared in accordance with the rules and regulations governing its preparation. According to the offering documents, Robinhood's significant growth technology and commitment to providing users a highly accessible and safe trading experience is what, quote, sets it apart from others in the financial services ecosystem. Then in paragraph 54, it repeats what they talked about, how Robinhood described itself as being customer friendly and quality and blah, blah, blah. So it repeats all that again. And then in paragraph 55, it says, with respect to Robinhood's growth, the offering documents applaud the increase observed in the company's transaction-based revenue in the lead up to the IPO. According to the offering documents, Robinhood earned over $720 million in transaction-based revenue by year-end 2020, which was 4 times greater than what it achieved the prior year, and reported over $420 million in transaction-based revenue in just the first quarter of 2021 alone, setting up 2021 to be a record year. So the offering documents are selling it up. This is what's happened. This is the revenue. We've had our best revenue ever, $720 million, leading up into the last quarter of 2021 when they are putting the or putting it up that through the year they are going to have a big year in 2021. In paragraph 56, it says the offering documents also highlighted the growth observed in certain key performance indicators to support the notion that the company's financial health was strong at the time of the IPO, and then there's a parenthesis that says, and would remain strong well into the future. Among other things, the offering documents flaunted Robinhood's, quote, net cumulative funded accounts, which were 12.5 million and 18 million for fiscal years 20 and 21 respectively. First quarter of 2021. Monthly active users, which were 11.7 million and 17.7 million for fiscal year 20 and first quarter 2021 respectively, and average revenues per user, which equaled 108.90 and 137 for fiscal years 20 and first quarter 21 respectively. The offering documents also highlighted Robinhood's assets under custody, which equaled nearly $63 billion and over $80 billion for fiscal years 20 and first quarter 21 respectively, noting in particular how cryptocurrencies comprised a significant portion of Robinhood's AUC, which is the assets under custody, in the lead up to the IPO, rising from over $414 million in fiscal year 19 to over $3.5 billion by year-end 2020, and a remarkable $11.6 billion in first quarter 2021. That's how they're saying they were set up with the initial public offering, is that there was all this buildup about how great the company was and that the company was on solid ground and that it would be so during the future. So now they're getting into where the claims come in. Paragraph 57. The offering documents, however, were false and misleading and omitted to state that, and they boldened this, at the time of the offering. So they are not saying that this is based on some forward-looking thing. They're saying at the time they released the offering, the IPO, on that date, they did not disclose, or they knew that the offering documents were misleading at the date of the offering. Robinhood's revenue growth was, in fact, experiencing a major reversal, with transaction-based revenues from cryptocurrency trading serving only as a short-term transitory injection, effectively masking what was stagnant growth. And it repeats that paragraph that I read earlier. Paragraph 58. Defendants were required to disclose this material information in the offering documents for at least 3 independent reasons. And again, this is information that wasn't in the other suit, that these lawyers are doing a great job putting this information together. First, SEC Regulation SK 17 CFR Section 229.303 required disclosure of any known events or uncertainties that at the time of the offering had caused or were reasonably likely to cause Robinhood's disclosed financial information not to be indicative of future operating results. So they're saying that Robinhood had a duty at the date of the offering, if they knew that there was some information that could mislead the potential purchasers at the IPO, and they had that information and could correct it, that they had a duty to correct it. They say at the time of the offering, Robinhood possessed information showing its revenue growth was experiencing a major reversal, and they restate what they've already said, and also talked about the data breach problems that they had. And it says these negative events and trends were likely to, and in fact did, materially and adversely affect Robinhood's financial state and render the disclosed results and trends in the offering documents misleading and not indicative of the company's future operating results. So paragraph 59, the second reason they give is SEC Regulation SK 17 CFR Section 229.105 required in the risk factor section of the offering documents a discussion of the most significant factors that make the offering risky or speculative, and that each risk factor adequately describe the risk. Robinhood's discussion of risk factors did not adequately describe the risk posed by the company's deficient efforts to enhance the reliability and scalability of its platform, which in turn impacted customers' ability to access their accounts, execute transactions, and control their personal information, and the negative impact such it was already having or would have on Robinhood's business, nor the other already occurring negative results and trends, nor the likely and consequent materially adverse effects on the company's future results, share price, and prospects. So the complaint saying that none of this information was updated to the investors in the regulation SK, which says that these risk factors were involved. They didn't include them in the risk factor section that these potential problems were there, according to the plaintiff. And then in verse 60, and then in paragraph 60, it says, third, paragraph 60, it says the defendant's failure to disclose, as the company eventually revealed, these risks had already materialized at the time of the offering. So them saying if or might or could affect the company, those would be forward-looking statements. But as the company noted, These risks had already materialized at the time of the IPO, and that's what's alleged here in paragraph 60. Then in paragraph B, which begins with number 61, it starts with the events and disclosures following the offering. On October 26th of 2021, after the markets closed, Robinhood reported its third quarter 2021 financial results, revealing that its total net revenue between the period between July 1, 2021 through September 30, 2021, the same period during which the company conducted its IPO, came in at $365 million, badly missing analyst estimates by nearly 73 million, and declines in its monthly active users, funded accounts, assets under custody, and average revenue per user. Robinhood also disclosed that third quarter transaction-based revenue from cryptocurrency trading was a measly $51 million, staggeringly below the $233 million Robinhood earned from crypto trading in the second quarter. The proportion of Robinhood's cryptocurrency transaction-based revenue generated by Dogecoin alone fell 40% in Q3, with Robinhood only generating $20.4 million in Q3 compared to $144.5 million in Q2. At the same time, Robinhood's net losses skyrocketed from $11 million to $1.32 billion due to a remarkable $1.24 billion stock-based compensation expense. That was tied to the stock's post-IPO performance and its initial rally, which boosted its shares to an all-time high of $85 a share on August 4th, 2021, and triggered a massive payout to defendants Tenev and Bot. To make matters worse, Robinhood also guided for less than $1.8 billion in revenue for the full year, implying a maximum 85% growth, which fell way short of analyst expectations of 111%. So the lawyers here in this complaint, the plaintiff, is laying out a pretty strong case on the fact that they're saying that the defendants knew at the time of the offering, they had these numbers, and they didn't come out prior to the IPO and say, whoa, we see some problems here. And instead of notifying the potential investors, they went forward with the IPO with the documents as they were, rather than saying, hey, we're in this quarter here, things are turning badly, we should probably let people know that. That's the allegation. I'm sure the defendants will have a different answer. Paragraph 62, analysts immediately took note with those at JP Morgan, for example, downgrading their price target and characterizing the company's trading revenue as a, quote, disappointment, noting in particular how equity trading was particularly weak, down both sequentially and year over year, despite a near doubling of accounts and MTUs, and how crypto trading revenue fell 78%, down more than the crypto industry average of 40%, and the decline of Dogecoin trading of 75%, before concluding, quote, we believe Robinhood has been over-earning and guidance will weaken for 2022. That's the guidance that's given. You know, I heard Meet Kevin and Ross Gerber on a live stream last night, and Ross Gerber was like, no, I'm not messing with Robinhood, I'm on Coinbase. And Kevin was essentially saying that he thinks that Robinhood might go on the way up. Well, these analysts here, at least for purposes of this complaint, have stated that in 2022, Robinhood's guidance will actually weaken. You know, Kevin's done a great job with his stock portfolio, so it's hard to argue with, but, you know, everyone thought Robinhood was going to go through the moon, and then this happened. So, well, I won't say everyone, the people who got burned by Robinhood earlier in the year, you know, they probably figured that out anyway. JP Morgan also questioned why management did not disclose trading volumes, finding it peculiar for a company generating 75% of revenue on volumes, but nonetheless suspecting revenue per trade had been elevated, indicating a weaker business outlook. Paragraph 63, on this news, Robinhood stock declined nearly 10.5%. Paragraph 64, on November 8, 2021, after the markets closed, Robinhood disclosed that it had suffered a data security incident on November 3rd, 2021, admitting that an unauthorized third party had obtained email addresses for approximately 5 million users and the full names of a different group of about 2 million users, indicating that the attack potentially affected nearly 40% of Robinhood's MAUs. What is more, Robinhood said the additional personal information of 310 other users, including their names, dates of birth, zip codes, were exposed, and within that group, 10 users suffered even more extensive breaches. Paragraph 65, on this news, Robinhood stock declined further. Paragraph 66, by the time this case was filed, and after Robinhood announced investigations into reports of bank transfer issues and issues with customers accessing their accounts, the company's stock traded as low as $17.08 per share, or over 55% below the $38 IPO offering price. And I love that these lawyers include these graphs. This is the graph showing the Robinhood decline from the IPO all the way down to when the suit was filed. I think that's pretty clever. But anyway, so the class action allegations, paragraph 67 through 73, are essentially just the boilerplate allegations that are required in order to certify a class. Then in paragraph 74 and 75, it makes the claims against Section 11 of the Securities Act. Paragraph 75, it says this claim is brought pursuant to Section 11 of the Securities Act, 15 U.S.C. Section 77K. This is a non-fraud cause of action. They're making clear that they are not proceeding on a fraud basis. Paragraph 76, the offering documents were inaccurate and misleading, contained untrue statements of material facts, omitted facts necessary to make the statements made therein not misleading, and omitted to state material facts required to be stated therein. And then paragraph 77 through 78 talk about the same things that have already been alleged generally. 79 is the same. Paragraph 80, defendants acted negligently in preparing the offering documents. None of the defendants named in this claim made a reasonable investigation or possessed reasonable grounds for the belief that the statements contained in the offering documents were true and without omission of any material facts and were not misleading. Paragraph 81 states that each defendant named violated. Paragraph 82, none of the untrue statements or omissions of material fact in the offering documents alleged herein was a forward-looking statement. So they are making the allegation that the offering documents were not forward-looking. They were projections based on what they knew at the time the documents were submitted, and that they were never updated at the time that the defendants knew that the company was tanking at the time of the IPO. So rather, each such statement concerned existing facts is what they allege. So they allege that this is not forward-looking statements, but this was involving existing facts at the time of the IPO. Paragraph 83 talks about how plaintiff acquired the securities without knowledge of the untruths or omissions. Paragraph 84, this claim is brought within 1 year after the discovery of the untrue statements and omissions and within 3 years of the date of the offering. So that's a statute of limitations language. And then paragraph 85 says that the plaintiff is seeking damages. Claim 2, violation of Section 12A. Paragraph 87, by means of the defective prospectus, defendants promoted, solicited, and sold Robinhood shares to plaintiff. Paragraph 88, the prospectus for the IPO contained untrue statements of material fact and concealed and failed to disclose material facts. And goes through what those material facts are again. Paragraph 89, plaintiff didn't know, nor in the exercise of reasonable diligence could he have known about those. And then paragraph 90, class members who have sold their Robinhood securities seek damages to the extent permitted by law, and those who were still holding Robinhood shares were seeking those as well. Claim 3, under Section 15, This claim is brought pursuant to Section 15, USC Section 77O. The individual defendants were controlling persons. So this is the claim against the individual defendants, Tentative and the others, because they were controlling persons. They were at senior management or had ownership interests or were directors, and they had the power to influence and exercise control, and that they did. Paragraph 94, each of the individual defendants are jointly and severally liable and to the same extent as Robinhood for its violations of Section 11. And then it ends with the prayer of relief that they are seeking for compensatory damages. They are seeking rescission, which means that they are trying to give the shares back to Robinhood in exchange for what they initially paid for them. They're also seeking reasonable attorney's fees, expert witness fees, and costs, and other relief as it may require. So I will be following this case as much as I can, and we'll try to update you on that. If you found this helpful, please subscribe to my channel and like this video. And please put in the comments what you think. Do you think that the lawyer did a good job setting Robinhood up for the case and Robinhood screwed? Or do you think that the plaintiff is likely to have the same outcome as Louis Pino did against Grant Cardone, and the court's going to grant a 12B6? Please put it in the comments. Let me know what you think. Let me know what you think about the analysis, about the video itself, and hope that you have a happy and safe new year in 2022 and that you're prosperous. And so please keep up with the channel. I'm going to do a lot of videos about investing, real estate, the stock market, about the law relating to those things, also about some personal injury. I'm mainly doing this as a personal injury lawyer to help people who get lump sum settlements to be able to have some information about how to protect and maximize their settlement. So I'm going to do a video about that, kind of an intro video. So be on the lookout for that. So until next time, stay tuned.